Having a good strategy when it comes to building your portfolio, whether you're a trader or investor, is one of the key factors that will either make you millionaire or broke in the long run. So watch this video and take the first path, since I will give you the exact things to consider and look into to grow your portfolio to 1 million. Hello guys, my name is Željko and welcome to Unsymmetric. So firstly, I just want to address that this is mainly for people that are focused on crypto space, so I won't be addressing how you should build a portfolio through various asset classes like stocks, bonds, commodities and precious metals. This video will be fully focused on crypto, so if crypto is just a part of your portfolio, you can still apply these principles that you're gonna see in this video with maybe slight variations, whether you want to be exposed to more or less risk in the long run. Now, when we are deeply in a bear market phase, it's probably the best time to think about structuring your portfolio and preparing for the bull market. We had many bad events in 2022, even the recent ones where the 10th largest bank collapsed, and now until the end of 2023, I expect inflation hikes to slow down. We have a Bitcoin halving in April 2024, which was usually a catalyst for a bull market in the past as well. I still expect one large pullback, and that's mainly the time when I'm gonna build my positions, but I'm definitely bullish in the long run. So when you're structuring your portfolio, the first things that you should take into consideration is whether you're gonna be trading, investing or both. Did you already invested all the money that you wanted, or you're adding some amount each month? How large is your portfolio? If you're at the start of your investing career, obviously it's much better to have a good stable job from which you can take some decent amount of capital each month and put it in your investment portfolio. If you decide to become a full-time trader too early and you end up in a situation that you need to make X amount of money to pay your bills and live your regular lifestyle, that will usually lead up to bigger mistakes and many frustrations along the way. So, in my opinion, even if you want to transition to becoming a full-time trader, you should have enough money to live at least for a half year to a year. Another thing that you should have in mind is that people seek excitement in the current markets, while instead to be successful in the financial markets, you need patience. Many people start trading massively during the bear market, staying over leveraged with unrealistic expectations, in a desire to make more money, while majority of them actually lose their money. You just need to stay calm, wait for right moments, and instead of aiming to get 20x from few trades in a bear market, which majority of the traders won't achieve even in their lifetime, you should just focus on finding great projects and narratives that will give you a massive returns once the bull market starts. So often asset distribution is the only thing that people think about when they're talking about portfolio structure, but there is so much more about it, as you could see. When it comes to asset distribution, the first question is how much time are you willing to put into research? If you're not willing to invest time into researching projects, team behind them, roadmap, how they're progressing, their socials, then probably the best option is to go either all in into Bitcoin, or anywhere between 20 to 50% into Ethereum and rest into Bitcoin. Also, if you're managing your own funds, in my opinion, you should be aware if we are in a trending or ranging markets and macroeconomic factors around us, since this will greatly impact the approach you're taking. Yes, you can always DCA in the projects, and again, if you're not willing to do research, this is probably the best and safest strategy. But if you're able to understand where we are in the market cycle and what is happening around you, that will multiply your returns. Also, the larger the portfolio that you have, the more you should think about capital preservation and you want to lower risk exposure. The less money that you're investing each month, again, the lower risk exposure you should have. If you really want to test some things out, invest in small projects, trade or anything similar, I would advise you to take small amount of money like 1% from your main portfolio and play with that, test things out, but never take like 20, 30, 50% of your main portfolio where you're building your long-term wealth for something that you haven't tested in real markets. You might often feel, oh, this is great and unique opportunity. It might be tempting but have in mind that the majority of the new things won't give you safe and consistent returns in comparison to strategy that already help you to get to the point where you're currently. Trust me, I was victim of this as well. Some of them will bring you profits, and I even encourage you to try new things, but always start small because majority of them will be losers. Same applies for trading. For example, average trading is becoming more and more popular nowadays, but instead of taking $10,000 from your main portfolio to start, take $100 and build from there. Make 200, then 500, then 1000. Prove yourself that you know what you're doing, and even then, once you get to some larger amount, take some of these profits and transfer it to your main account. Buy something, reward yourself for the success that you obtained. Since you got to this point in the video, I'll assume that you're willing to put the work in. In my opinion, you should not invest in less than 8 currencies and not in more than 20. Anything below 8 is, in my opinion, too little diversification. Anything above 20 is too much that it becomes very difficult to track what's happening with each one. So let's see the example chart. The first coin that you should have is obviously Bitcoin, and you should have anywhere from 20 to 50% depending on the market conditions. When you expect Bitcoin dominance to go up, probably closer to 50% as we are currently in. When we are switching to alt season, probably in a lower range around 20 to 25%. Second thing that I want to address are stable coins. In my opinion, you should always have some stable coins on the side, anywhere from 10 to 80%. Obviously 80% would be the moment when the bull market ends and the markets are crashing, and from the other side saving at least 10% in case we have some major market crash that would offer you great opportunities. Third coin on the list is Ethereum, as a blue chip alt that has a good historic performance since it went 60x during the previous bull market, while Bitcoin went around 20x. If this growth ratio of Ethereum and Bitcoin would continue, Ethereum would take over the first spot on market cap during the next bull run. I would invest anywhere between 10 to 40% into this one. For the rest of your portfolio, first step would be to look into different niches, categories, and see with which one you're familiar with and which has good potential. For me, I believe in interoperability between different chains. That's why I picked Polkadot, for example. I believe in scaling on Ethereum and projects that will create cheaper transactions in the future, like Polygon and Optimism, or Arbitrum as well, but it doesn't have its own token yet. Due to all bad events with centralized exchanges and the one that I personally experienced, unfortunately, I think that DeFi will be a big thing both on a long and short term, especially since it evolved to the point that you can create limit orders, aggregate liquidity across different chains, and high interest rates from staking and yield farming. Gaming and NFTs is another big segment, although I believe that in order to achieve full potential, we need to improve lots of things. In-game economy, graphics, even gameplay to bring Web3 games to the standard of Web2 games. AI and data monetization would be the last thing here that I'm both familiar with and that I think it will grow during the next bull run. Also have in mind that this is not my current portfolio or the exact asset distribution that you should have. It's just an example how to distribute your money across different categories and assets when it comes to balancing risk-reward ratio. I would stick to a range of 2.5 up to 10% per project. Everything above 10% exposes you too much to risk, while everything below 2.5% keeps you at low upside potential, and it's much better to invest more money into one of the projects that you already have than to invest, let's say, 0.3% into something new. The main reason is that you should stay up to date with the projects, and if something is not performing well, maybe it's better to cut it off early. Be aware of the fact that there isn't single perfect portfolio distribution and that the markets usually grow in narratives. So recently we had an AI narrative, Ethereum staking narrative, Layer 2 narrative, Chinese coins narrative, so often following what's trending and looking for the coins that haven't pumped in price yet in these narratives can be a good approach. But be careful. In my opinion, it's better to miss some narratives than to go into some area that you have no clue about, since there will be always opportunities in the space, and if you just manage to preserve your capital now, it's much easier to make money in the bull run. Also, don't marry specific projects or coins. If you see that it's not going well, exit, find something better, and also don't be afraid to take profits. Usually it's best to scale in and scale out of the project, so don't be disappointed if you bought something for $2 and sold it for $5, but it still went up to $7. Be happy about the gains that you made. If you have any questions or there is some topic that you would like me to cover in the future, please comment below. I would really like to hear the feedback on the videos. Thank you for watching, stay strong and healthy, bye! Perfection consists of two things, discipline and consistency. One of the most common reasons why people fail in crypto markets is because they don't follow their own rules. Once you develop a solid strategy, discipline and consistency over a long time frame is what will give you compounding returns over time.